I think cross-collateralization also plays up not just from a negative equity side of things. Like even if you have the equity in place, if you are crossing it against your own place, you are basically limiting and blocking in your borrowing completely, right? Because, it's just one big freaking loan that basically sits there on the books. Even from a tax perspective, it becomes quite cumbersome as well at times where, you can't tax deduct it if you haven't set it right because you've gone from $500,000 to $1 million loan because they might not set it up separately.
You're listening to Help Me Buy Property podcast powered by Investor Partner Group. We help improve lifestyles by building scalable and sustainable generational wealth and passive income streams. We do this via our ecosystem that is a one-stop shop to all property investment needs. From evidence-based, data-driven buyer's agency, industry-renowned portfolio reviews and property strategies, property development with and for clients, tax, SMSF, business structures advisory, and cash flow real estate. Everything we do is to help people achieve financial independence and not just basic financial freedom by using property as a tool and as a medium. Presently, we've launched Australian Property Academy where we are training and teaching buyer's agents, property advisors, property strategic partners, and secrets to finding investor-grade properties to astute investors. Connect now to experience it yourself or drop in a line below at info@helpmebuy.com.au to get more information. Be kind and happy investing.
Hello and welcome to Help Me Buy Property podcast. Today we are going to talk about big lenders and the loan ports. I think no one ever talks about loan ports or port loans and the release of security and how the cross-collateralization basically F-ups your borrowing capacity. In order to talk about this topic, we have Hung in our studio today. Hung from Strategic Brokers. Welcome, Hung. How are you today?
Yeah, good. Thanks for having me again. Porting of loans. This is a topic that nobody ever talks about.
No one.
Nobody actually knows the rules.
And I think people don't even understand what port loans are and how do they work and what do they do. And
I'm not going to lie. I think I'm probably one of the brokers out there who does the most portabilities of anyone out there.
Really?
I do so much of it. It's ridiculous. Like even last week we done one where my client sold one of his properties for a very high number.
Yeah.
And he didn't want to let go of the loan. He couldn't borrow the money anymore.
Yeah.
Right. And that loan was with a major bank. So it's a really good quality loan. The interest rate on that loan was 5.89 or something like that. You can't even buy that in the marketplace at the moment.
Yeah.
And he had the ability, because he sold that property, he wanted to buy some investment properties, right? So we figured that we could probably squeeze 2 investment properties in there to replace the loan. That's called a port, right? So we just taking one security, getting a settlement date and swapping it with 2 more securities. Same time. Yeah. That's what a port means. You're porting out the security. So we managed to buy, I said to him, this is the settlement date on your sale. We have to buy 2 properties, settle on the same day and switch it all around. So that's what we did last week. We got everything to work.
It's amazing, like how many, like I would say, but probably 99% of the brokers don't even know this exists. People think that this is a US sort of thing.
Yeah, no idea.
It's so common in Australia. Like I think I did my first port loan in 2017 or 16 when I first found out about it. I was like, Jesus, like I don't need to close the loan. I can just move the securities underneath them.
Like, and another example is I met a guy who is very substantial portfolio. Probably, I would say his portfolio is close to 20 million.
Yeah.
And his house, his own occupier, is probably worth 12 of that 20, right?
Yeah.
So, that 8 investments. But he's been trying to buy properties for ages because he has all these loans with a major and he's had all these properties just sitting there. Yeah. And then he goes, I've spoken to so many brokers, no one can get me any more loans.
Yeah.
Something like, mate, have you not thought about porting out some securities and then taking low doc loans?
Yeah.
Your investment properties are yielding like 20%. Who cares if you lose a little bit of money on the low doc?
Yeah.
Like it's like we said on last episode, treat it like a business. Separate your own occupier.
Yeah.
Your investment properties are profiting $100,000 a year. You can afford to absorb $100,000 of negative gearing even if that gets to zero, right? Realistically, who cares?
Yeah.
Because really you're looking for capital growth now.
Yeah.
So that's what I guess porting in a nutshell is basically switching securities, releasing securities. In some cases you even switch it with a term deposit for cash because it's at the interim fix until you find another property to replace it.
So for the users and listeners, let's help them understand in really simplistic terms, how does this work?
Yeah. So basically, if you have the property has to be acceptable to the lender.
Yeah.
So you might have, call it your. Let's say you live. Let's use an owner occupier as an example. It's probably the easiest one, right?
Yeah.
Let's say you've sold your house. It's worth $1 million, and there's a loan for $500,000 on it.
Yeah.
And you wanted to keep that mortgage, but you've bought another property, for instance, because you I don't know, your circumstances might have changed or whatever. You bought another property for $800,000. You're gonna net off. You want to keep the cash.
Yeah.
For the proceeds of the sale. If you can settle those deals simultaneously, in theory, you can just swap the properties and keep the loan as long as it's below an 80% loan to value ratio.
Yeah.
But this is one thing that also is not all banks are the same. So there's probably only 2 particular lenders that will let you just do whatever you want up to 80%, right?
Wow.
The other lenders will only let you go back to your original loan to value ratio.
Oh, really?
That's the thing. Yeah.
Original is in the first time that you got
Yeah.
it.
So if you bought that property at 70% LVR,
Yeah.
they will only let you do ports with 70%
70%.
LVR, but everyone else will do 80%.
Yeah.
Another example is some banks can port to what they call port to term deposits. So let's say you sold your property for $1 million, but you haven't found a property that you want to buy or secure yet, right?
Yeah.
But you need to keep this loan facility.
Yeah.
And you haven't found a property. So you sold this for, you have a $500,000, you sold it for $1 million.
Yeah.
So obviously in a normal circumstance, the bank would have to close the loan, right?
Oh, yeah.
But you sold off $1 million, so you're gonna technically meant to pay out the loan, but you're not gonna pay it out. You've got proceeds of $500,000.
Yeah.
What they can do is put that $500,000 in term deposit.
Yeah.
It's secure it against that
the
loan.
Yeah.
But then you're gonna have to pay interest on that loan. That's the thing.
Yeah.
But
Yeah.
given the circumstances, things might have changed. You just recently went self-employed. You were PAYG. You can earn the money to make the repayments, but the bank's not going to give you a below 6% rate ever again to get that. You're going to be in these low doc funders at 8% or whatever you're going to be. It's a good option for interim fix until you can get the next property.
Yeah.
So 3 months later, you might find that property. You swap the term deposit out for that new property, and then the surplus funds get deposited back into your account.
The second thing, which is very important that I learned about port loans, was that no servicing. None of that basically gets triggered. No questions asked.
Correct.
Basically, so you might not be working at all, but you port and boom, it just basically goes through.
Yeah, it's something that I like sharing on. Like, this is a great channel to share it on, because people don't know about this. Like, the amount of times I've told people about this, they're like, "You could do that?" I'm like, no. I'm like, yeah. And they're like, okay. Now, and then people go through this whole rigmarole. I've spoken to customers before. They're like, sometimes they spoke to a broker. Broker goes, "Oh no, the only way we're going to get you from here to there, we're going to set up a company, do some private lending, lose $50,000 on the chat." I'm like, man, you're getting robbed.
Yes.
Like, these guys are, I think, and you got to make sure that you're doing. A good broker will always do what's best for the customer, right? But these
100%.
guys, I've seen some fun stuff out there, so I've just come and help.
What's the shame? When you see a lot of people who are downsizing, and they're not using the port loans as an opportunity. Like, I see so many opportunities being lost, right? Because all you're doing is downsizing. You have a loan and you are close to 60s. You know that the bank is not going to talk to you, not the golden child to the bank anymore. And why would you close the loan? Like, why would you not keep the debt because your LVRs are so low? Just move them across, buy an investment property and create a cash for yourself.
It's wild. Yeah, I've seen so many opportunities sitting there as well in the past. I've even actually used it for family before, to port, keep the loans, buy investment properties and downsize, and then allow them some more passive income. Yeah, obviously shove more in super as much as they can at the time. Yeah, so they can then get some tax-free properties in super. We're very property focused, but so
I think the important thing also is that, or the sad thing, not the important, but sad and important, I should say, is that while port loans and, releasing and playing with the security is such a less talked topic, what I see a lot of brokers doing, and it's a disservice, is cross-collateralizing the loans left, right, and center. And that basically, F-ups the ports, right? So let's talk a bit about the collateralization.
Yes. So, man, it can become an absolute nightmare. Right? I used to be a banker, so I remember having to go through the systems to uncross stuff. So they allocate percentages whenever they cross.
Yeah, like
they're like 4%, 7%. So whenever you set up a new loan, you have no idea. Then what they do is the bankers get lazy. They just go, I can't be bothered. Just link them all together.
Yes, like a web. Yeah.
The most disgusting thing I've seen is actually like going back years ago, was somebody bought like a house in a mining town, like really far out. They would have. I think their mortgage was like $800,000, and the property was valued at like 300 grand or something like that. Like he had shrunk. This is probably the most absurd story I've seen, but but they crossed that into their own occupier.
Wow.
And their own occupier was like a unit, something like that. And these guys have been crying out, just like they've spoken to somebody spooked them, got them into this property, and they came to me and I go, I can't help you. You've crossed these two properties, right? I can't actually. And their own occupier, which was like a unit, was almost paid down. You know what I mean?
Yeah.
But now they're negative equity because of this crappy property there.
Yeah.
You know, but the property was still yielding okay, so you could kind of just sit and fizzle, but that wasn't allowing them to upgrade. Because they couldn't draw equity because they got negative equity.
Correct.
Because of the collateralization.
Yeah.
You know, the two properties are linked. So if they had done it properly and they had that property, look, it's 300 grand, you know, owing, whatever it was, 700 against a 300 grand, you know, value, that can just stand alone, right? And if their property is almost paid off, I can just take that to another bank, draw equity, help them get their own occupier, and just, you know, let that thing just rot and do what it does. But that it lets them keep pressing forward with their life. Yeah. All right. If they're crossed, then they're not going to press forward. They're stuck because everything's linked to each other. You can't do one thing without the other. So big sign in our office is actually like this sign. We're making money as an art. We have do not cross collateralize. That's our rule in our office.
Don't get yourself taken on a ride by property spookers, so-called property investment advisors, or buyer's agents who are selling house and land packages or off-the-plan properties or apartments. Get yourself a copy of this book called The Millennial's Guide to Property Investing. This book is not just for millennials. The title suggests, but it's actually the most advanced way of investing in property. You know, this book will relate to your clients, your colleagues, and other business owners. There are so many property spookers out there who have come out of the woodwork over the last 3 to 5 years, and there is so much misinformation out there that I had to write a book about all the F-ups that people can actually avoid in order to be super successful in the property investment journey. Some of these are really easy to identify, but they are so costly to fix once these mistakes are made. So it's a short book, it's easy to read, it has a lot of stories, it has a lot of examples, and it is a true guide for people who wants to do it themselves. My name is Mohsin Reza. This is my story, and a lot of you will relate to parts of this story if you're not born in the riches and if you're trying to build a property portfolio that can last generations and help you improve your lifestyle along the way. So I give you a chance to come out there and have a read. Be kind, stay safe, keep smiling, keep investing, and please do check out the book.
100%. And I think cross-collateralization also plays up not just from a negative equity side of things. Like even if you have the equity in place, if you are crossing it against your own place, you are basically limiting and blocking in your borrowing completely, right? Because, it's just one big freaking loan that basically sits there on the books. Even from a tax perspective, it becomes quite cumbersome as well at times where, you can't tax deduct it, if you haven't set it right, because you've gone from $500,000 to $1 million loan because they might not set it up separately. So talk a bit about that, how much pain can cross-collateralization cause from an investor's perspective? And if you don't do that, how does the sky look like?
Yeah, so sometimes you end up in situations where you need to, maybe take a security to allow you to progress in your life, whether it's in business, whether it's in, personal, whether it's to buy or leverage more property from a lender that's going to accept you. But if you are linked and crossed and everything, then having that limitation, like we said before, it's going to stop you. You're going to be missing out on every opportunity that comes, right? So yeah, it is extremely important to make sure that, you understand the fundamentals of that. I have a customer of mine right now. This is probably more for business customers, but there's also a thing called the GSA, which is, like a general servicing agreement. Yeah. I haven't heard about that. Yeah. So that's when they take income from different companies that you own.
Oh, sure. Yeah.
And they make that guarantee.
Yes.
The guarantee a mortgage somewhere else. But then that might cause that entity not to be able to borrow money now.
Yes.
So you might really be reliant. It gets to a more complex web when you get to that level. Yeah. But it's similar in that sense to crossing when you're linking things together. But yeah, everything's standalone, everything in its own, it's its own little environment. Yeah. And
what about these mom and dad banks and, using your parents' freaking houses to, cross them against your houses or take them as guarantees? How does that plays into all of this? Because I see a lot of that happening right now as well, where people are like, I don't have a deposit, or I need X amount of money, and I'm going to basically reach out to mom and dad's bank.
Yeah, that's actually something we do so much of nowadays, because it is hard to save a deposit. You know, median house prices at $1 million.
Yeah.
Sydney, what are we now? 1.6. Crazy, right?
Almost 1.6,
Yeah.
1.68.
You know what's Melbourne at 1 point, just over the ones, right?
Hitting one, I think one. Yeah,
Brisbane just past one as well. Yeah, so
crazy.
Even if you're going for a 20% deposit, right, which is standard lending, you know, that's 200 grand. You know, stamp duty, 50 grand, call it, including collar, right? Pretty hard to save, right? So you've got to save pretty aggressively, even $1,000 a week. I mean, you know.
So what's the best way to tap into the mum and dad's bank, you know, rather than just picking them up? Can you go for personal guarantees, or do you actually, you know, basically hold their property as a mortgage, or, you know, how does it
work?
So
technically nowadays there's probably one lender that you can use parents. You can use actually brothers, anyone that's family, grandparents.
Really?
You know? So yeah, rather than just being your direct parents.
Yeah.
Most banks will only accept their direct parents, but there is one funder out there who will accept, you know, family members to help guarantee. But basically, the bank takes a limited guarantee on their property. So let's just say, you know, Bob has a property, it's worth $1 million, it's unencumbered, and Bob's son, John, wants to buy a property. John, you know, he wants to buy for $1 million. So he needs, and he has no deposit. Let's just say he has no deposit, right? $0. What would happen is the bank would take a limited guarantee on the father's property, which is Bob, and the bank wants to make sure he has 80% equity. So
sure.
So if the property is $1 million that Bob's buying, okay, and he's going to take out a loan for $1,050,000, right? I'm trying to do some quick maths in my head, but what? $1,050,000 divided by 80%, right? Yeah, I think it's 1, 3.
Well, million, 80%, that's like 200,000. So that's 800,000. And yeah.
Correct. So they need to hold 80% security against that loan of $1,050,000.
Sure.
So yeah. I can't do the maths in my head for some reason right now. But it's basically a limited guarantee of just over 250,000 or so, probably closer to 300 grand that they hold as security. So Bob will be only limited if anything happens. So what would happen is, the idea is that the son would have to pay the mortgage.
Yeah.
And then if they are unable to pay the mortgage, the bank, you know, and they obviously default on it, the bank's going to come after them first.
Sure.
To see if, hey, what are you going to do about this? If they sell their property and don't recoup the funds, then they can come after Bob, the father, for a limited amount of up to, say, 300,000.
Sure,
you know?
Whatever the deposit was, basically.
But that's a really long, strenuous process, right? And in a general sense, ideally, when we take these guarantees, we'd like to see it below the 100% ratio if you can, if you go on above it, but you can go up to 105%, even higher, plus costs in some instances.
Can you do guarantees through SMSF and Super as well? I heard some banks showing some of that appetite there.
Parental guarantees through SMSF?
Yeah.
I haven't seen that, to be fair. Yeah, no,
I just knew it somewhere, like this is last 2 weeks, where there is this one company that is basically doing some sort of ways where they're pulling money out from Super, guaranteeing it in some way, shape or form, and using that as a deposit for a kid's property. So yeah, I don't know how they're doing it.
In the Super environment, you say?
No, outside.
Outside of it.
Yeah, it's weird and it's funny, but you know, it was a lot of red flags for me. So when I heard about it,
that's interesting, because I wouldn't know how the mechanics on that would work, but I'd assume it'd only be for, say, somebody who's in the pension phase where the funds are accessible.
Exactly. I think what they are typically doing, and this is what my understanding was, and which was quite scary from my perspective, was they're reaching out to these people who have hit the preservation age, and they're like, okay, you know, your son needs the money, so we are going to pull this money out from Super, let's say $350,000 or $300,000, and you're going to give you X% return, and you invest into this equity fund, and they take that money there into equity fund. And then they give their son a house and land package at the back end, saying 20% of this is basically that money. And then when he catches up the equity, then you can cash out and draw out as well. So it's like
So in a traditional sense, there's one funder that has been doing this forever, is that if the parents don't want to put security up put up a property as security, they can put a cash in a term deposit.
Oh yeah,
security.
Okay,
and use that as a guarantee. It's a cash guarantee.
Yeah.
So I find I do a bit of that as well. As for the guarantee thing, like I'm not against. I actually love it. I think it's a great opportunity. Like
bank guarantees.
just like as in just like allowing the kids to get into the market, right?
100%.
Because only if they're buying good property, and how they determine good property is
Don't buy.
yeah. If you're buying a apartment in the 400 block unit, then I as soon as I see that, and I do a guarantee, I always say no. Sure, I'll look. I really have a think about this.
Yes.
Yeah, and I'll explain to you why. And I always sit everyone down and go, look, yeah. If you're buying a house, townhouse, good area, what we call Cat 1 securities, and then we're all for it. You know, it gives kids the opportunity rather than
100%.
renting to build their nest egg very quickly.
Definitely.
Yeah.
Definitely. If you bring this all together, port loans, where do we sit? You know, let's give the last sort of 2 minutes, spiel to people so that they can understand.
Yeah, so I think if you are, I guess, trying to downsize, portability is very important part of the puzzle potentially, because then you don't have to go through bridging finance, right?
Yeah.
And you can create yourself, but it depends on the numbers. So if that's something that you're doing, make sure you do speak to, speak to a good broker. You don't speak to your bank, because the good broker will have you know where to place it.
Yeah.
If you have a fair few properties, make sure they're not crossed when you're working all with the one bank.
Yeah.
Because then it makes it quite difficult to port. If you want to figure out if your bank allows you to port, then reach out to us and we'll be able to help you figure it out, because not all banks can port, and not all banks can port to certain loan to value ratios. And whether you're going to port and then use that port to then expand your portfolio, you've got to figure out how. So
100%.
Yeah.
Golden words, where can people find you?
So reach out to me at, just jump on our website, strategicbroker.com.au, and you'll see all of our profiles. You can click on me and all my details are there.
Awesome. Thank you very much, Hong, today. For viewers and listeners, if you have any questions, comments, concerns, jump in if you've done a port in your life before, or if you're wanting to learn more about port loans. Thank you for listening to us today. Stay kind, keep safe, keep investing, keep smiling. This is Moss and Hong checking out. Adios.